This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. Dan O'Brien, K-State grain economist, begins today's show with a grain market update. He talks about crop acreage projections and balance sheets. Continuing the show is one of the keynote speakers from the Women Managing the Farm Conference, Matt Roberts, as he discusses why people could be dealing with labor shortages and how interest rates haven't been normal for a while. K-State meteorologist Chip Redmond finishes the show with this week's weather update. He reminds people that as it dries out, fire safety needs to be more heavily considered. That and more is coming up ahead on Agriculture Today. You're tuned in to Agriculture Today, and we start our Friday show with a grain market update. And as always, we're joined by K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Thank you, Shelby.
Dan, you're currently in Washington, D.C., listening to the USDA and some of their presentations. And what have been some key takeaways you've heard?
Well, Seth Meyer, the chief economist for the USDA, gave a presentation on Thursday morning, and also the USDA has released ahead of time the so people can look at it, the grain and oilseed outlook numbers, and they're all pretty pessimistic in terms of prices. But here's the general takeaway. Main points would be first that with these projections, early season on, assuming great weather and no disruptions generally, we would see rebuilding of U.S. corn and soybean stocks and the weakening of prices to go along with that. But we'll see actually a little bit of rebuilding on for U.S. wheat stocks, but world stocks still tight, rice stocks tight. But again, the issue of what's happening in the Black Sea region for the wheat market still a prevailing limitation. So that's the first point. Second point would be that, again, one of the reasons for the strong for the growth in stocks and the weakness of prices is just strong export competition for corn and soybeans from Brazil and Argentina, and it's still anticipated to happen, and in the wheat market from the Black Sea region, and more reports come out yesterday that whether true or not, Russia anticipates even more production coming in. Ukraine numbers still not projected to show any major cutbacks. So strong export competition across the board, particularly from Ukraine for both wheat and corn. So that keeps driving us towards something you and I have been talking about, Shelby, the increased domestic emphasis of U.S. grain usage and our lack of export competitiveness. Our currency high valuation is part of that for sure, but also just success in the overburdening supplies anticipated in the South American countries, especially Brazil. Third point would be just geopolitical uncertainty. These projections were made assuming no more wars, not beyond what we know anyway, what's going on at present time, and that we wouldn't have any more transportation disruptions, just like we've seen in the last several months in the Red Sea area, and the canal, Panama Canal, would open up, be no problem, et cetera. So these are all pretty healthy assumptions. They may or may not occur, but that's what these pretty bearish projections are based on. And then finally, the caveat that really weather has the last say, both here in the U.S. and on world markets in terms of where prices will actually go. And it's probably no surprise that you've got a bearish projection right here during February when the markets don't have a lot of news, or any news really, about U.S. production prospects other than what's on paper. Again, nothing's in the field other than the winter wheat having been planted, so no risks being accounted for yet, and so we we have this situation. I would say that if you want to, we can talk about some of the details of some of those balance sheets, particularly for corn, soybeans, and some other crops if you'd like.
Go for it, Dan.
Okay, sounds good. For corn, big issue that came out, probably the most relevant number to the market was that in projection by the USDA that we'd plant 91 million acres of corn, down from 94.6 million, and that we'd have, again, a record yield of 181 bushels per acre. Last year, the USDA came out projected 181.5. Well, we ended up with 177, which is a record high yield. So they're coming in again, almost just like last year, projecting 181. And whether we get that or not will be a big question. So far, I guess it's all right to say, hey, I think probably we should plan for 177.3 until we actually break that record. But that'll be an issue of debate in coming months. Another 15 billion bushel corn crop. By the time you work through the balance sheet, et cetera, you'd have ending stocks actually rising from about 2.17 billion up to 2.53. So increase in stocks to use going up from about 14.9 to 17 plus, and the price, if you actually got record high yield, all of that we just talked about, you drop the price from 480 per bushel in the U.S. down to 440. So if the big issue again is the yield, the acres. So if corn acres drop from 94.6 this year in 2023 down to 91 in 2024, then for soybeans you've got acres going in the other direction. 83.6 is what we had here in the 2023 calendar year. They projected 87.5, up just 3.9 million acres. And I think they're looking at relative soybean versus corn prices, again, with the corn market being off. Again, 52 bushels an acre, record high yield, again, projected by the USDA. It's kind of standard fare, really. At these meetings, they project high yields. And so you end up with 4.5 billion sized crop and ending stocks going from 315 million this year with the February projection that we just had a couple weeks ago up to 435. Prices dropping as a result from 1265 down to 1120. I don't know if market analysts, when they look at these numbers, are they cognizant of the general mode of what these projections are. They're full great year projections, and so you've got building of stocks projected for both of those, and if that occurs, then prices drop. So that's what you've had. I would say take a quick look at wheat acres down a little bit. Again, not just following from the seedings report and other projections that came out in early January, and ending stocks for wheat going up just like for the other commodities with that almost 50 bushel yield, 49.5 and a half. Nationally, going from about 658 up to 769, and again prices dropping dramatically from $7.20 down to $6. So far as prices go, we haven't had any good news. But again, you're assuming at or near record high yields for every one of these commodities, and moderate usage, no runaway exports, etc. You do see for grain sorghum that you have a little bit lower planted area yields, about 69 bushel an acre. We have certainly had higher than that. You end up with a season average price for sorghum 440, just equal to corn. But they do show the one fly in the ointment, I guess, for the grain sorghum size. They're projecting about just under 300 million bushels of grain sorghum exports, and we're projected to be about 240 this year. And if that happens, gosh, if you had that strong an export deal, you'd wonder if prices would still stay that low. So anyway, overall, that they're projecting tight margins for farmers, that the ratio of revenues to costs, the last three complete marketing years was about 125%. They're projecting this year that ratio basically drops down to even money, basically 100%. And so that would be a bit of a tougher year for farmers. And listening to the financial talks here, they have talked a lot about how the last 3 years we had higher prices, we built up some equity, we had government support that helped farmers, and so we're in the process of probably probably using some of that up, and so they're not anticipating a financial crisis this year, unless things get a lot worse than it's projected here. But we're heading towards a situation where we're cutting out for average farms, representative farms, all that much more of any cash carryovers we had from the last 3 years, and are on our way, if we continue like this, to a tougher financial situation, if not this year, then coming into next year. Probably if you get a tough year like this projected, then where would we be a year from now would be probably the question to ask.
Dan, then to round out today's conversation, thinking about prices still, but a little bit more towards the consumer, you heard about some food price inflation there.
Yes, pretty stout topic to talk about. That they looked at the price of bread in 2020, about $1.35 per unit, and $2.03 in 2024. So that's a 30-some% inflation. Price of beef back in 2020, $3.89. Now, per pound average, $5.03 in 2024. So again, you've got 20, 25, 30% inflation on the food cost side. And in general, that higher cost of food wasn't the biggest thing talked about, but particularly in our meat cuts. And again, Glenn Tonser in our shop talked more about this and better than I can. But inflation in costs and tightening pocketbooks probably brings home for beef the specter, the possibility of higher price cuts being something that are a little harder for consumers to buy. But again, in our shop, we have other folks that can talk about that with much more veracity than myself.
Dan, I appreciate you taking the time to join us today and give us our grain market update.
Thank you very much. I appreciate it, Shelby.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now, but we'll be back with more ahead. You're tuned in to Agriculture Today, and we continue our Friday show talking with a keynote speaker from the Women Managing the Farm Conference. And today we're joined by Terrain's Senior Grains and Oilseed Analyst, Matt Roberts. Matt, thanks for joining us today.
Thank you for having me, Shelby. Matt,
talking about a few things you shared with the attendees at the Women Managing the Farm Conference, and one of those points discussing labor.
As I travel around the country talking to farmers in almost every piece of the farm economy, different production, different crops, different states, the one thing when I ask them, what's your biggest challenge? Almost always, number one or number two is labor availability, having enough help. And of course, this extends beyond agriculture. We've been talking about it for years. And in fact, we've been talking about it well before COVID. But I think post-COVID, we talk about it more. And one of the things I really want people to understand around this topic is the labor market that we think of as normal is gone, and it's gone forever. What we're living in today is the new normal. And there's a couple factors that lead us here. The first thing is when we think about generations. We hear so much about the baby boomers. The baby boomers were born between 1945 and 1965-ish. So that middle year is 1955. If you were born in 1955, you turned 65 in 2020. So we are right in the heart of baby boomer retirements. And the generation coming in to the workforce is Gen Z. And as I like to remind people, if you get a cool name, you're a baby boomer, you're a millennial, then you're a big generation. Gen Z, or like me, Gen X, we're small generations. So we have the largest generation in our country's history, the baby boomers retiring, and we have a relatively small generation, Gen Z, coming in. And the other thing, this is all against a background of a declining birth rate in the United States. And so this idea of labor availability that was the norm is gone, okay? It's not coming back. And we need to realize that when we make our staffing decisions. A lot of people, will mention, hey, I think that, or I've heard that there's lots of people sitting at home living off of government payments. And the reality is where the workforce has shrunk is not in the prime working age. It's actually in that 55 and up, those baby boomers. When we look at people who are between the ages of 25 and 54, We have the largest percentage of those people in the workforce since the George W. Bush administration. So it's not an issue that they're out of the workforce. The numbers just aren't there.
And really then maybe need to think of different things of how can they still have enough resources to get that work done?
Yes. And so we're going to have to, and we already have been adapting to this over the past certainly 10 to 15 years. The question of how we're going to deal with this is important. The first thing that we always do is we substitute capital for labor, right? We get kiosks. You go to the airport, check in at a kiosk. McDonald's, you have kiosks. We're going to do it through automated tractors, automation, less worker. We're going to do it through immigration. Many farmers I talk to have H-2A employees, very commonly from South Africa, but that's also pretty complicated and it's not cheap, but it's another way. What else are we going to do? We need the labor. The other point that I really want to make, and it's one of the reports that we have at terrainag.com by my colleague Matt Clark, highlights that all of these issues are actually worse in rural areas, that the labor shortages are actually worse. The unemployment rates are lower in rural areas than they are in suburban and urban areas. So everything we talk about this at a national level, it's actually magnified for farmers and ranchers. And so how we deal with this is going to be crucial. One of the other things I always like to really encourage farmers is the cheapest employee is the one you already have. If you're waiting until your hands or people that you have working for you are coming to you asking for a raise, then they already have one foot out the door. And it's really time to start thinking about how can you be a better employer for them? Not just pay little things, making sure they have nice trucks. If you give them a pickup truck, make sure it's a nice one and turn it over more. What are your benefits packages? All of this stuff. And again, the fundamental issue here is it's not changing.
And something else that farmers also deal with besides just labor, interest rates.
Oh my gosh. Yeah. I mean, this is, and I think particularly for younger farmers, they've really spent 15 years knowing that, okay, interest rates matter, but they don't really matter. Okay. So what my operating line is, what my land loan is, I care, but it's not a driver. But now we've gotten to a point where operating lines now maybe 8.5% to 9.5%. That really matters. For example, if you have corn that you're storing right now in the bin and you've got balance on your operating line and that's 9.5%, that's actually changing fundamentally your profitability of storage. Now, one of the things I really want people to understand, the normal interest rate is not zero. These last 10 years have been such an aberration. The normal Fed funds rate is really 3 to 3.5%. And so that means, that's maybe 2% lower than what it is now. So short-term interest rates as we normalize will probably come down. But when we talk about long-term interest rates, the normal rate is maybe more like 5.5%. And that's actually about 0.75% higher than where it is. So when we look at interest rates on, say, land loans or residential mortgages, even as we go to a more normal level, I don't expect to see those rates fundamentally come down. That 3% mortgage we've heard so much about, I think is a historical aberration that I wouldn't be surprised never to see again in my lifetime.
And something, however, that we are seeing this lifetime, a lot of farmers being able to work with the environment and advocate for the environment.
Environmental, both awareness, advocacy, also regulation is a piece of every agricultural producer's life in a way that I don't think many of them could have even fathomed 20 years ago. And one of these, again, the world we live in is different than it was 20 years ago. And one of the ways in which it's different is it's radically richer. Both the United States, and we lose track of this, is radically richer than it was even 20 years ago, and same with the rest of the world. And although this is unpopular, environmental regulation, environmental awareness, environmental caring is really something that is a privilege of wealth. If you live in an incredibly poor country, if you live in Venezuela, if you live in North Korea, your worry is not about water quality or air quality. Your worry is about how do I feed my kids? How do I feed my family? How do I make it to next week? Yeah, it may suck that the air is highly polluted, But if my kid doesn't have their sufficient daily caloric intake, and 20 years down the line, emphysema is the least of our worries, right? In America, in Europe, in Canada, we are wealthy enough to care a lot about these things. And by the way, that's great. Okay, if you don't believe me, travel to some of these poorer countries and you'll suddenly think, Clean Air Act may be a good thing. But the takeaway from this, particularly when we think longer term and how we run our farms, environmental regulation is not going away. Now, as administrations change in DC, we may see 2 steps forward, 1 step back, but the steps forward are always going to outweigh it simply because we're a wealthy nation who's growing ever wealthier. So I think really a takeaway for this, particularly again, young and beginning farmers, a way that they truly have to distinguish themselves is in thinking about how do I learn how to really exploit, understand, embrace, and exploit environmental regulation. How can I really lean into carbon programs and stacking those with the FSA? Again, another colleague at Terrain has a paper written on how to monetize conservation payments, and it's all about how do we stack FSA and EQIP programs with carbon programs. And looking at it not necessarily, I mean, one can be very idealistic, one can be cynical. Either way, looking at it as a business decision, because there are a lot of farmers out there who've been doing things the same way for many years, and they don't need to deal with this. They don't want to deal with it. For those who are young, really embracing administrative compliance can be a source of sustainable long-term competitive advantage.
Matt, I appreciate you taking the time to join us today and walk us through a few things that producers probably want to keep in mind.
Here's what I want you to keep in mind. First, just going over what we just talked about, labor, it's not changing. Labor is always going to be tight from here on out. Learn how to be a better manager. Don't just worry about reading books about the markets. How can you be a better manager, keeping the people you have? Interest rates, learn how they matter. Know that 3% mortgages are not coming back, and that's okay. It's the way the world mostly worked. Finally, regulation, not going anywhere. Understand it, embrace it, like it or not, that's the world we live in. Some other things, a way, again, that I think producers will be able to sustainably differentiate themselves is through better books. Understand your business. There's an old saying, if you don't measure it, you can't manage it. And that is one of probably my most preached tenets.
Thank you, Matt. That was Terrain Senior Grains and Oilseed Analyst Matt Roberts. I will link the resources that he mentioned in today's show notes on agtoday.net. We're cutting to a short break now, but we'll be back with more ahead. You're tuned in to Agriculture Today, and we conclude our Friday show with a weather update. And as always, we're joined by K-State meteorologist Chip Redmond. Chip, thanks for joining us today.
Yeah, thanks for having me.
Chip, we've had a warm start to February, and is that something we're going to continue to see?
Yeah, we have. Basically, since that cold snap that we had in January, we've been warmer than normal. And when we look at just statistically, since the start of February, we're in the top warmer starts to February. Start being, we're over halfway through the month now. But we've kept our overnight lows very warm, and we've been reaching highs in the mid-60s almost every day for a lot of the state. And so that, as a result, is running our average temperatures in the third to fourth warmest start on record. And, it's a big 180 from that cold snap in January, but overall, we've been warmer than normal for most of this winter. And we're starting to see signs of it, starting to see daffodils and buds on the trees. So things are progressing as if we're entering early spring, but we're not done. We still have potential for cold. We're still early enough. Our average lows are in the upper teens, to near 20 degrees, and our highs are supposed to be in the mid to upper 40s, near 50. So we still have the potential for cold, but so far we've been warmer than normal.
Do we have any potential for moisture with this warmer weather?
Yeah, so we're going to have cooler weather here this weekend, and with that cool front overnight last night, Thursday night and Friday, we saw some light snow in the northeast part of the state. But overall, chances of precipitation are overall low. We have a had a transition in the pattern where we're still keeping an active storm track for the West Coast, but that's keeping high pressure across the plains, diverting most of those storms to our south or to our north and keeping this region high and dry. We've been about 10 to 12 days, depending on where you're at, except for the far southwest and southeast corners, without moisture, which has been a good drying out. We needed it across the state, but, we also need to keep moisture coming to keep above our averages. And, right now, for the central part of the state, we don't get rain the rest of the month, which seems very likely that we'll almost end the month below average or near average, with offsetting a lot of that moisture we saw at the beginning of the month.
As things are drying out and it is Wildfire Awareness Week, wanting to remind people that there could be a little bit extra danger?
Yeah, things are drying out on the landscape. We've had that just about 2-week period of dry conditions. That means the grass is drying out daily now with lower humidities and any sunshine that we have. So fire will spread very, very quickly, and probably quicker than people think, especially because our minds are still focused on the wet conditions we've had the last few weeks. But, fire season is here in Kansas, and any wind and sunny conditions and lower humidity is going to equal elevated fire weather concerns. So just be smart with your fires. If you've had previous fires, make sure you check them.
And we've talked about it before, but there is a tool on the Mesonet that is really good for people to go look at.
Yeah, you can find the fire danger forecast. Just puts Smoky Bear ratings. We call it low, moderate, high, very high, extreme fire weather out the next 7 days using the National Weather Service forecast. You can find that at mesonet.ksu.edu, mesonet.ksu.edu. Hit that menu in the top left, those 3 bars, go to fire, and then fire danger forecast.
And what could we possibly be seeing for weather as we look through the end of this month and into the beginning of March?
Yeah, so we'll be warm and mostly dry into early March, and not really seeing any significant pattern change. There's some hints at another active period for the south where we might bring in some cooler than normal, but not very cold per se, cooler than we've been in early March. But as you get into spring, we're starting to see that pretty good signal of El Nino to La Nina transition focusing around May. That tends to lead towards more active weather, both in precipitation, but severe weather as well. So thinking this severe weather season might be elevated compared to what we've seen the last few years. Precipitation will likely return come mid-March and persist to early May. And then once we get into El Nino conditions into that late May and then into June, July, and August, drier than normal conditions are favored for most of the state. So we could potentially see some reemergence of drought and definitely concerns with precipitation as we get into the summer months.
Chip, I appreciate you taking the time to join us today and give us our weather update.
Yep, thanks for having me.
That was K-State meteorologist Chip Redmond. I will link the Mesonet tool in today's show notes on agtoday.net. That's all we have for you this week on Agriculture Today, but we'll be back with more for you on Monday.